live checking in, live checking in. We are live checking in. Let's make sure we live. Make sure we got some sound. Let's make sure we got some activity. Yeah. I love it. Welcome to the live. Welcome to the chat. Welcome to a beautiful morning. Hello? Listen, man, I'm super excited and pumped up. Man, let me tell y'all something, man. It's something that just gets me over the top excited about a new month. Man, God blessed us to see a new month, man. Yesterday was June 1st, but today, man, it's June 2nd, man, and I can just smell the goodness. I could just smell the glory. I could just smell, man, all of the beautiful, marvelous things that are getting ready to happen, man. So, man, welcome, and welcome again. All right, man. So, as you guys know, we go live each and every Tuesday. And let me introduce myself. So my name is Jerron Tyler, founder of Posterity, an AI-powered business credit software that helps entrepreneurs all over the country maximize their business credit understanding as well as their funding. And today, or like every Tuesday, you know, we just like to go live simply to spread the good news, if you will, of business credit as well, so that entrepreneurs, man, just simply have options, are able to put their hands on resources to help them along the way. I believe that as many entrepreneurs as possible to have access to resources, man, we could just build an overall better world, a better economy, and a better society. And so with that being said, today's topic, we're going to be talking about why businesses get denied. Okay, why businesses get denied. Business credit is one of those things that I believe can stand as an enigma. It can be very puzzling. A lot of times entrepreneurs want to know how to get it. They believe they see the value in it. But they just don't simply have the roadmap to get there. And so whether you're talking about going inside of a bank, reading a book, looking at something on YouTube, talking to a consultant, man, it's just so many different layers that comes along with business credit and business funding. And so what we want to do is we want to provide you, again, man, with just enough insight along the way and on the journey. They're different and there are many variances, if you will, or many layers when you start talking about business. You got marketing, you got fulfillment, you got product creation, product evolution, you got staff, you got systems, you got workflows, you got customer service. You have, your digital footprint, if you have websites and landing pages, and, obviously in today's time, we have AI, so we can utilize artificial intelligence to help us get things done more efficiently, when it comes down to creating things. But in addition to that, you have this beautiful thing, this beautiful concept, this other beautiful component of every business, which is finance. If you do not have a tight hold on your finances, then the economy is going to have a hold on you. It does not matter how dominant or prominent you believe you are, you think you are, your product is this, your product is that, your business is this, your business is that. If you don't have someone that is overseeing the finances of that business, then that business will soon be out of business, right? Or you won't be able to maximize your revenue, your profitability, etc. And so these are key components, and we're going to talk about this side of that spectrum today regarding finance, right? Why do businesses get denied funding? All right, and so we'll go ahead and get started on this, man. So the very first thing that I want to talk to you guys about, and I actually discussed this in a video before. However, the first thing that I want to talk to you guys about is the concept of being overexposed. I did a recent video on this talking about why one of our clients, she actually came to us after the fact, but why she got denied $21,000. She was in a situation where she should have gotten approved for a bare minimum of $21,000, but she ended up getting approved for about $7,000 to $8,000. And the reason being was because she went to a specific banking institution. She went to a banking institution that she already had 2 personal credit cards with. Now, these 2 personal credit cards, I think she had a $21,000 card and maybe like a $17,000 card. Needless to say, those cards were practically, over the 50% limit. And so because those cards were over the 50% limit, she's now in a situation where she has solid credit, her business is structured properly, she's making revenue. However, the bank is now she's now overexposed with that bank because that bank has an increased liability with her specifically, right? Because she now already has over, $25,000, $30,000 in debt with that one institution. And so when she went in to go and get her business credit card, it wasn't that, again, she got approved, but the reality is she was simply over leveraged. She had already stretched out on $30,000 with that one institution. And so that's something that I want you guys to keep in mind with, going through the funding process. Can be like, solving a puzzle. It can be like, going and playing Tetris, because just because, she was overexposed with that bank does not mean that she had overexposure in the marketplace as a whole. She could have gone to that. She could have gone to another bank and gotten that $21,000 because her debt in and of itself wasn't astronomically high, but the reality is that institution had already given her enough. I'll give you guys an example. So specifically with PNC. PNC, one of my favorite banks, had a lot of favor with PNC as well. They gave me a business credit card as well as a business line of credit. However, PNC gives maximum exposure of $100,000. So, for example, if you're somebody that has a $25,000 credit card as well as a $25,000 business line of credit, then if you were going in for a auto loan, then they would give you a $50,000 auto loan, but you would be maxed out at that. Now, granted, that was at the time when I first started out. It was a no-doc loan or no-doc funding, if you will, where I was, just going out and I was getting business lines of credit, business credit cards, and I specifically got them with them as well. But they had given a max, and so banks will do that. They'll give you a max, they'll give you a cap. They'll say, hey, we'll fund you, but you have a maximum capacity, if you will, at $100,000 or at $150,000 or at $60,000. Right. And so that's just something that I want you guys to keep in mind because it's vitally important. Imagine being in a situation where you could have gotten $50,000, but because you went to the wrong bank, you ended up only getting $8,000. Or you could have gotten $60,000, but because you went to the wrong institution, you ended up only getting $14,000. Right. And so at the end of the day, all money is a blessing, especially when you start talking about funding, especially when you start talking about 0% interest funding, because you have anywhere between 9 to 18 months, if you will, 15 months, depending on the bank that you go through. You got that much time at 0% interest to go out and build your business, to go out and expand your company, to go out and pretty much use free money. And so, it's a blessing. And so I never harp much about, I only got, I went to a bank before. It was at the time it was Sandy Spring Bank, where they only gave me $3,000. Right now, you guys know my philosophy: get as much credit as you can before you need it, because it's better to have it and not need it than to need it and not have it. And so I got the $3,000 and never even used the $3,000. Right, but I'm always storing up for the future. You guys never know what life might throw at you, what business might throw at you, more importantly, what opportunities might come your way. And so if you have an overwhelming amount of opportunities that come your way, you can go out and raise capital. That's a good skill set. But another thing you can do is you can go out and get your own funding. And so you got opportunities to buy businesses. You got opportunities to be minority owners. You got opportunities to go out and expand your current operations. What if you could put your hands on $70,000? What if you could put your hands on $170,000? What if you could put your hands on $370,000? Again, the whole concept of money, the primary purpose of money is to utilize it to make more money, period. That's the primary purpose of money. is to use it to make more money. How can I make it grow? How can I expand it? How can I cause it to create more opportunities for me and my counterparts in the marketplace? And so, with that being said, man, let's go ahead and get started. Let's go ahead and get started. Live topic is going to be why good businesses, not just businesses, but why good businesses get denied funding. All right. So let's go here. All right. So, all right. In an instance, you ever wonder why, how is a quote unquote good business or a profitable business getting denied funding, right? Well, what's a quote unquote good business or profitable business? I mean, let's say somebody's business is, generating 50 grand a month. They're doing $600,000 a year in gross revenue. And let's just say hypothetically, out of that generation of the 50 grand, depending on which business model, what type of business you're in, let's say they're netting. After they pay out the staff, they pay their expenses, they pay everything that needs to be paid. Out of a $50,000 gross, they're netting 20 grand. So they're grossing 600 grand a year, and then they're netting $240,000 a year. Let's call it $250,000, right? So they're netting this. Most people would say, well, yeah, that's a pretty good, decent business, right? You get to walk away with $20,000 every month. Well, why would somebody like this get denied funding? So I'm gonna go to my board really quick and write down a few reasons why a business that is grossing. So we have our gross, and they're grossing $50,000. And out of the gross of $50,000, they're netting $20,000. So they're walking away with $240K a year, and then they're grossing $600,000 a year. Now, in this situation right here, you're in a situation where even though you're in a situation where you're making $240,000, there's still components that you absolutely must be aware of. And that one is your personal credit. All right, so we have personal credit here. And then we also have business credit here. We also have time in business here. We also have revenue. We also have cash flow. We also have industry risk. And we also have bank relationships. All right, so what I want to do is I just kind of want to go down. I want to go down the list of all of these just to kind of discuss them really quick. So when you start talking about personal credit is one of the key and major components when it actually comes to applying for business funding. It's not end all be all, but it is a huge factor and a huge component when you start talking about applying for funding, because banks want to know, how have you managed the current affairs that you have now? Period. Like, I understand that you want 50 grand. I understand that you want $100,000. But with every single benefit, there is a burden. There's a burden to the benefit. And so the benefit is you get to go out and get 0% interest funding. The burden is, man, I need to see how you've currently managed your current affairs, right? And so, man, I want you guys to think this and always know this. Before I get to greater, I have to manage the lesser. Before I get to greater, I have to manage the lesser. And so many times people have a distorted understanding and vantage point of view of business funding. Banks want to lend money, but the primary purpose of the bank lending money, it depending on where you are, yes, they want to reinvest into the community. They want to make sure the economy is flowing. But at the end of the day, they're looking to make money. right? If it's not a credit union, that bank is a for-profit institution. They're in business to make money. They make money off of interest rates. They make money off of deposits. They make money off of investment accounts. They make money off of real estate loans, automotive finance loans. And so that bank is not looking to go into a bad partnership with anybody. They want to assess you. They want to evaluate you. This is the whole purpose of underwriting. I want to see if you are worthy, if you are credible, if you have ample credit score, if you've managed your affairs properly in the past. And so this is one of the reasons why they look at the personal credit score. Now, there is a world where your business credit can trump your personal credit score. There is a world, but oftentimes that world comes along with having longevity. Right? You want to have been in business for 2, 3, 4, 5, 6, 7, 8, 9, 10 years. You want to have generated revenue, not just one good month, not just one good year, but a couple of good years. Right? Are you somebody that has made 150 one year and then the next year you tank the 20 grand? Are you somebody that's made 70,000 one year, the next year you made 400,000 and then after that you back down to 40 grand? Right? You have to show a level of consistency. You have to show a level of foundationalness, if you will, right? I'm making up a word, but you want to be able to show that you are rooted, you are grounded. But again, one of the main things that they look at is they look at personal credit score. And when we start talking about personal credit score, one of the things that will prohibit you from getting approved from any type of funding is going to be derogatory marks, specifically within the last 24 months. And so if you're somebody that's had a late payment in the last 24 months, that could hurt you. It will hurt you. If you're somebody that's had collections, you still have collections on your credit report, that is something that will hurt you. Charge-offs, bankruptcies, anything on your credit report that would create a negative component. All right. And so you want to keep that credit score as tight as possible. This is why I say this is another reason why, before I move on to the next point, this is another reason why when people talk about, obviously I talk about funding all the time. I talk about business credit, business funding. I think it's one of the most powerful tools ever created, because you get the opportunity to leverage credit and you can almost max out credit and not affect your personal credit, right? However, one of the things that I want people to understand, and for everybody watching right now, I want you guys to understand that it really doesn't matter in the grand scheme whether you have personal funding or business funding, because the ultimate goal of money is to use the money to make more money. I'm going to say that again. In the grand scheme, it does not matter if you have personal funding or business funding, because the ultimate goal of money is to use it to make more money. All right. So I'll give you an example before I move on to my next point. If somebody on the line or somebody watching this live right now is looking to get into franchising businesses, if you're looking to begin buying franchises, if you're looking to begin buying businesses, if you're somebody like myself and you want to get into developing software, if you want to, go out and start your own transportation company, your own trash removal services, your own digital marketing agency, your own barbering agency, you want to sell jewelry, right? Whatever it is, at the end of the day, what matters is that you have the capacity to put your hands on the capital. Like, when it's time to put your money up for an opportunity, like, who cares if it's business or personal? If I have an opportunity to go buy a tropical smoothie or Blaze Pizza or a Pizza Hut or Alitos, whatever the case may be, and I have to come to the table with $200,000, I really don't care where the money comes from, whether it's the personal side or the business side. So I wanted to just drive that point home, because I know a lot of times people can try to lean heavily into the business side. I want you to lean into the profit side. I want you to lean into the cash revenue generation side. I want you to lean into the net worth side. I want you to lean into the business buying, business creation side, that you may go in and create revenue and generate revenue. Jerron, what's the whole purpose in you saying that? If you're generating revenue, it's going to solve all of your economic problems. every last one of them. And so I could pull from a personal line of credit. I could pull from a business line of credit. I could get a grant. It's so many directions that I could go in, but I just want to make sure that all of my listeners right now are taking a very holistic approach, because you may be in a situation right now where you're not strong enough to go get business funding. You may be in a situation right now where you're strong enough to get business funding, but you're not strong enough to get a loan. You can only get a credit card. You may be in a situation where you're strong enough to get a credit card, but you can't get a line of credit yet, right? Can't get a line of credit, but you can get a business auto loan. It's so many different ways to skin a cat. Like, it's so many different ways to skin a cat, man. And that's what I love about funding, but that's overall what I love about life. Man, I'm trying to sit down and figure out what a solution is. I don't have a lot of time to play. I don't have time to waste. I don't have time to keep talking about why I can't do this and talk about my limitations. No, I'm here to, man, infuse into you your possibilities, no matter what space or state you in. So with that being said, the next one we have here is we have your business credit. Now, when you start talking about business credit, this can, if you have tarnished business credit, this can hurt you immensely. I'm gonna give you an example. So we had a guy come to us, and I'll put this in blue since we're talking about American Express specifically. So we had a guy come to us, and he had an Amex. Now with this Amex, on the Amex, he only had about an $8,000 limit. However, he ended up defaulting on this Amex. Defaulting, he just stopped paying the Amex, and the Amex ended up going into collections. Now, with this card going into collections, it now puts a red flag over the entire business. And so now that he has a red flag on that business, that hurts him from going in and applying for different types of funding at different institutions, because at the end of the day, they're looking at that name or that defaulted account being attached to his business name, right? So obviously, you go into a situation and you're in a space where you're trying to go out and get funding, but you technically can't because your account is now tied to an account that has had a default. Now, Jerron, what would you recommend in that situation? All right, so I want to write it down because I think this is a really good scenario and topic for you guys. All right, so we're in this situation, and let's call it, just so I don't put all of his business out there, let's call it Alfonso Enterprises. So we got Alfonso Enterprises, and he's in a situation where he has an Amex, and it was an $8,000 Amex. However, again, as I mentioned, the Amex has been defaulted on. He has not paid it, and it's now gone into collections. Well, this collection now affects the actual, watch this, business credit score of his company. So it affects the business credit score. Now, another thing that you guys will see is that when you're talking about cards that are personal guarantor cards, right? Meaning you had to put your social security number up for the card. You had to actually serve as a personal guarantor on the card, right? You had to put your social security number up. You made yourself liable for the card. So if you default on the card, they're going to come after you technically. Well, in this instance, you actually have, two negatives, a double negative, because it affects the business, but then it'll also come and affect your personal credit score. Now, institutions operate differently because some may send it directly to your personal credit immediately. Some may take 2 months. Some may take 6 months, right? Because one of the other things that I want you guys to know as well, this is a great credit tip for you guys. Oh, yeah. Oh, yes. Phenomenal. Yes, phenomenal question. One of the things that I want you guys to know is that institutions actually have to pay. It's going to blow your mind. So banks actually have to pay to report to credit reporting agencies. They have to pay. So every last one of your banks, favorite bank, non-favorite bank, whatever, Bank of America, Wells Fargo, PNC, M&T, Truist, all of these banks, they have to actually pay Equifax, TransUnion, and Experian. They're paying them to report, which is why you see some people may have a higher credit score than others. Well, why does this person have a higher credit score? Okay, because that bank that they defaulted with actually does not report to TransUnion. They only report the Experian. That bank that they defaulted with does not report to TransUnion. It only reports to Equifax. So you have a fluctuation in score. And so that's something that I want you guys to keep in mind. But again, if you default on a business card, it can affect your business or will affect your business, but it also can and will eventually affect your personal score. So that's just something else to keep in mind. All right, now, when you come here, you have this collection. Now, Jerron, Jerron, I know you talk a lot about solutions, man. What would be the solution that you would go with here? Now, in this instance, he has two directions that he can go in. He can actually go in with American Express and try to figure out what type of settlement they can come up with in order to have him on track where he can either pay this off, pay this down, and somehow reconcile this $8,000. Man, Bank of America, how can we reconcile this $8,000? Is there any way that we could get this removed from my business credit report? Getting it removed from your personal credit report probably won't be as hard. However, the main factor that you want to look at is getting it off of the business credit report. Because again, if I am an institution and I come to you and I'm in a situation where you are reaching out to me because you want funding, I'm like, yeah, don't mind giving you funding. But at the same time, like, is there a reason why you did not pay these people their $8,000? Is there a reason why they do not have their $8,000, right? These are things that you want to keep in mind, all right? Because who wants to lend to somebody that is not being honorable when it comes to actually paying out their money? Now, the next thing, as far as a solution, in this space, you've defaulted, you have a card right here, and you did not pay them their money, but you're trying to go out and get funding. Another thing that you can do, because again, on this channel, all we're talking is solutions. You have this. The next thing that you can do is you can simply, man, just go and create another LLC. Now, you go create the other LLC. Now, there's multiple things that I want to give you right here. You created the LLC, and you simply, let's say, I'm just keeping the name simple. You go out and you create Alfonso LLC, right? You go create Alfonso LLC. Now, in this instance, remember, if your personal credit is clear, then you won't have anything to worry about, because perhaps you got this reconciled. Perhaps they didn't report it to your personal credit, whatever the case may be. All right, you're clear as long as your personal credit is good. However, here's something that I want to give you guys. If you are going out and you are applying for funding on your own, if you're applying for funding on your own, you never, and I repeat, never, ever, ever want to apply for funding and go back to the same bank that you defaulted with. I don't care if your credit score went from a 580 to a 980. If you did not do right by that bank, do not go back to those people asking them for anything. And I mean anything. Don't go back asking them for nothing, because you're not gonna have a successful process. It's not going to be a successful journey. You're not going to get approved, because although you have reconciled, you've gotten your credit together, your credit has now become a 1,000 out of 100, out of 0, right? You now got this 1,000 credit score, and you say, I'm gonna go back to American Express and they're going to approve me. No, they're not. They're not going to approve you, because they still internally in their system can see that you did not do right by them. And so again, just having the knowledge. What did King Solomon say? And all that get understanding. You got to have the knowledge in order to be successful. So if you default with American Express, don't go back there. If you default with American Express, go to Wells Fargo. Default with Wells Fargo, go to Bank of America. You default with Bank of America, go to a local credit union. You defaulted with a local credit union, go to a regional bank. Defaulted with a regional bank, maybe you need to come sit down with me so we can figure out what in the world is going on and why you keep defaulting with these people. But, man, you just want to be wise and you want to be shrewd when it comes to navigating the whole component, if you will, of applying for funding. So I hope that makes sense. All right, now on to the next one. All right, so just circle this for you guys real quick. The next one we have here is time in business. All right. Time in business. It's one of the reasons why people can get denied due to their time in business. What I recommend as a rule of thumb is that when you're first starting out and you're looking to go out and get approved for funding, depending on what your credit score is, you may be able to, get an LLC and go apply same week. Banks have been tightening up. However, you can go out and get approved for something in the same week if you have a solid enough credit score. However, if you have a seasoned business, LLC, S Corp, C Corp, nonprofit, right? If you have a seasoned business, it gives you greater opportunity to actually go out and get approved for funding. Jerron, what do you mean by seasoned business? I mean, when you throw that seasoning on that chicken and you just let it marinate. Hello? That's what I mean by seasoned business. I mean, how long has the chicken been marinating? How long have the lamb chops been marinating, the pork chops, the pork ribs, the beef ribs? Hello? How long have the turkey wings been resting in that seasoning? Hello? Man, listen, this is what I'm talking about when I'm talking about your business. How long has the business been in motion? Did you just start the business 30 seconds ago, or has it been in business? Have you been in a flow for 30 months? Okay, have you been in a flow for at least 30 weeks? Have you been in a flow with the business at all? And so they're looking at your actual time in business. All right. Now, what does this matter if somebody has a quote unquote good business, Jerron, like you started out with? Good business, the business is profitable. All right. Your business could be profitable day one. Your business can be profitable in 6 months. Your business can be profitable in a year. However, you do have institutions that may give you a very strong rubric or very strong underwriting guidelines where they say, I don't care how profitable your business is. Our guidelines say you have to be in business for 2 years. All right. I don't care how profitable your business is. Our guidelines say you have to give us tax returns for 2 years. I don't care how profitable your business is. You have to be able to show us balance sheet, profit and loss statement for 2 years. All right. In order to get approved for this particular product right here, you have to be generating at least $375,000 a year, right? So everybody has their own underwriting guidelines that you absolutely must keep in mind and adhere to, because it's vitally important, especially, man, when it comes down to being in position to actually get approved for the funding. All right, now the next one that we have, all right, next one that we have here is we have your actual revenue. Revenue is the lifeblood of every business. It's the lifeline. If you ain't generating revenue and your for-profit business is not a for-profit, it's a non-for-profit, and we need to get you to safety immediately. Okay? Your revenue is the lifeblood and the lifeline of your business. And so with that being said, when you start talking about revenue, you want to make sure, obviously, that you're in a healthy place. But there are some banks and some underwriters, some underwriting guidelines, if you will. Let's say we were talking about fintech lines of credit. They're also known as revenue-based lines of credit. And so if I have a revenue-based line of credit that I am applying for, then the ultimate umbrella or ultimate foundation of the underwriting process is going to be based on revenue, period. It's going to be based on revenue if I am applying to a revenue-based loan. All right. If I'm applying for a revenue-based line of credit, it is going to be based on revenue. And so a lot of revenue-based financing companies, they typically, the lowest that I've ever seen has been about $7,000 a year. $5,000 to $7,000 a year. I've never seen below $5,000. Okay, but $5,000 to $7,000 a year, you can go out and get you some funding. No, I'm sorry. Let me rewind that. I've seen, $5,000 to $7,000. Yeah, I've seen people get approved for $5,000. But $5,000 to $7,000 is the lowest that I've ever seen get approved on a actual revenue-based line of credit or revenue-based funding. Now, sweet spot, standard, all right, standardized underwriting for revenue-based is anywhere between $10,000 to $15,000 a month. At $10,000 to $15,000 a month, you could be a 620 credit score. You could be a 625 credit score and still get approved. Why? Because revenue is the key component here. Revenue is the key component here. That's the main focus. That is the star of the show. That is, the quote unquote statue. Like, this is the main focus. And the good thing that I love about revenue-based financing is that even if you've had derogatory marks, I want you to hear this, even if you've had collections, even if you had a late payment in the last year, they will overlook those things if you have strong enough revenue. Now, notice I said at minimum, as a standard, very, very low minimum, a baseline, $5,000 to $7,000. But as a standard, if you're making anywhere between $10,000 to $15,000, then you're in a situation where you can override this whole concept of having challenge credit. You can override it. And so with that being said, it's something that I want you to keep in mind as well, because this is why almost on every live, I'm going to tell you guys that you want to have what? Credit and revenue. I got credit and revenue working for me. Credit and revenue. If I have my credit and my revenue working for me at the same time, I am unstoppable in the marketplace. I'm unstoppable in the economy because I have the maximum amount of leverage to carry me through, right? I got two dynamic, powerful crutches working for me right now. I got the crutch of my finances and my revenue coming in. I got the crutch of my credit. So if my credit get low in one season, I got capital. If my capital get low in one season, I got credit. Nothing can stop me. And so in this instance, one of the things that I encourage people to do is to focus. Don't just focus on the credit. Focus on the revenue. Focus on your revenue as well. Because if you focus on your revenue as well, like everything in life revolves around patterns. Anybody can figure out how to do anything, right? There's nothing that you can't do. John Hope Bryan said something amazing. He said, Black people have been doing, so much with so little for so long that we could practically do anything with nothing. Man, it's so true. Man, but I would speak that into humanity, right? Black, white, Anglo-Saxon, whatever, it does not matter. If you have a brain, if you can think, if God created you, then there are solutions for you, and you do not escape, the velocity of patterns, right? Jerron, what do you mean by pattern? I mean that you can figure out how to do anything by way of the patterns that have been interwoven into our earth, right? If you figured out how to go get funding, then you can figure out how to start a business. If you figure out how to start a business, you can figure out how to get funding. If you figure out how to get funding, you can figure out how to make money. If you figure out how to make money, you can figure out how to generate revenue at a large scale. There's no limit. If you figured out how to make $10,000 a month, you can figure out how to make $50,000 a month. If you figure out how to make $50,000 a month, you can figure out how to make $150,000 a month. Figure out how to make $150,000 a month. Can you figure out how to make $500,000 a month? Everything is possible. There's nothing off the table. There's nothing that's, something exclusive that's set aside to the quote unquote elites of the quote unquote world or the earth. There is no such thing, right? Everything that will be has already been. Everything is in the earth. There are patterns, right? So it's just having the mindset and the perspective, that I can actually go out and create more revenue. Now, the thing is, we believe that doing business is a cause for good. You're not lying. You're not stealing. You're not contorting. You're not congealing anybody to go and do anything, man, for selfish ambition. But you can create more revenue to better infuse it back into the quote unquote community, the region, the world, the earth, your nonprofit. Man, what are you passionate about? Who can you hire? You can't hire a whole team of people making $2,000 a month. You can't hire a whole team of people and build out a massive staff making $5,000 a month. You making $60,000 a year with 60 employees. You cannot do it. So if you're creating more revenue means more opportunity. More revenue means that you can hire more staff. More revenue being hire more staff, creating better systems, creating a better work environment, man, creating and being able to provide better training for your staff. Right. So, hey, that was my spill on revenue. But that is the key with revenue. You have no doc loans or no doc financing, and then you also have doc financing, right, where you have to provide docs. But in this instance, they're just looking at those bank statements. By the way, before I go into this next one, because my whole mission is to infuse in you guys as much economic information as possible. All right, when you start talking about a product like a DSCR loan, I want to give you guys a little bit of insight on that as well before I move forward. So a DSCR loan is simply a real estate loan. It stands for debt service coverage ratio loan. And DSCR loans are specifically for business owners, entrepreneurs. Even if you weren't a business owner or entrepreneur prior to, once you get that DSCR loan, you have now become one, because they only give loans to those who have LLCs or have S Corps, C Corps, whatever. You have to have a business entity in order to get an actual DSCR loan. Well, DSCR loans work similar to revenue-based financing because they do not care much about your credit score. They do not care much about your actual revenue. They don't care about your tax returns, but they care about the sustainability of the property. So I'll give you an example. If you're going to buy a property and you're utilizing a DSCR loan, typically they require you to put anywhere between 15 to 25% down, right? The very common spot for it is 20% down. So if you're looking at a property, you put 20% down on that property. Well, once you put the 20% down on the property, they're now looking at, like, number one, you qualify because you have money down. They're now looking at your savings. Sometimes they want to see reserves. Sometimes they don't, depending on your credit score. So there could be an instance where they want to see 6 months of reserves. Reserves is just the amount of mortgage payments that you have. Sometimes they want to see 3 months of reserves. Sometimes they don't even care about the reserves. The number one thing that they care about with a DSCR loan, similar to revenue-based financing, is that they care all the more about how much rent is coming into that property and if that rent can take care of and cover the mortgage on that property. All right. That's what they care about. So congratulations if you're somebody out here that doesn't have a 700. Congratulations if you're somebody out here that doesn't have an 850. Congratulations if your score is not a 990, right? If you are able to go out and source a deal and find a deal that makes economic sense, then there's great possibility and chance for you. So I just wanted to drop that on you guys really quick because it's one of the most dynamic products that I see in the marketplace today, man. If you are in real estate, thinking about investing in real estate in any way, shape, form, or fashion, I highly recommend. I mean, a DSCR loan is the greatest. You can leverage them. They're not worried about your debt. They're not really worried about a debt to income ratio. You can have 1,000 DSCR loans. Because the payment is not based on, man, that's so good. The payment is not based on your personal income, or the approval is not based on your personal income. The approval is 100% based on, man, you being in a situation where you can actually go out and find other people to pay that mortgage payment. So that's what I want you guys to, focus on when it comes to that, man. Just wanted to throw that in there because we were talking about revenue based. Now, the next one that we have here, which is similar, but this is cash flow, right? Cash flow. Now, specifically, cash flow is very important when you're talking about business loans specifically, right? When you're talking about a business loan, because with a business loan, they're not just looking at revenue. They're looking at that cash flow. They're looking at your net profitability, right? You got some people out here that's like, oh man, I'm doing $1 million. I did $1 million this year, right? You did $1 million in revenue, but what did you net, right? If you did $1 million in revenue and you only netted $100,000, that's not bad. But, you know, that's another topic for another story. You know, are you a millionaire? Everybody got a different understanding of it. Are you a millionaire because you got $1 million net worth? Are you a millionaire because you cash flowed $1 million? A millionaire because you got $1 million in savings? Are you a millionaire just because you grossed $1 million? Are you a millionaire because you got $1 million in funding? I mean, you know, it's all relative, right? But needless to say, most business loan underwriters, they are looking for net cash flow, right? They're not looking at gross. They're looking at who cares? Like, yeah, you grossed $3.5 million. What did you net, right? What you net matters because that's going to be what you utilize to pay the loan back, right? So that's what you want to look at. You want to look at, all right, what are you actually netting? And so that's one of the reasons why business could get denied, because they're in a situation where they're doing $380,000 a year. They're doing $600,000 a year. You're doing $250,000 a year, but every month out of that $240,000, if you're grossing $240,000 a year, right? I'm sorry, you're grossing $600,000. If you're netting $240,000 a year, that means you're making $20,000 a month. You're making $20,000 a month, but even in that $20,000, after you paid out expenses and all of that good stuff, you still gotta tap into that net because you got super crazy high car notes and a super crazy high mortgage, and you know you paying yourself or you're not paying yourself through your W-2, right? It's so many different components, but they're looking at the actual cash flow that you put your hands on, because the cash flow that you put your hands on is the only thing that's safe, right? I can't trust what you're grossing, because what you're grossing is still going out in expenses. So that's something to keep in mind as well. All right, next one. We have industry risk. Okay, we have industry risk. There are some institutions that absolutely hate certain industries. So prior to going into a business, unless you are ridiculously passionate about the industry, I would highly recommend that you evaluate and you assess if the business is high risk. Is it a high risk business? You know, I would highly recommend that you guys actually go in and ask yourselves, like, is it a high risk business? Like trucking is high risk. When you start talking about construction is high risk, right? And so it's not to say that you should not go into it, because if you're passionate about a thing, you can get funded in anything, but certain banks will just absolutely deny you because of the risk factor. Another industry that can be very high risk can just be transportation. Another one is car rentals, high risk, right? Because I mean, obviously, you renting a car to different people, and you got your insurance attached to it. Who's to say that person is going to properly take care of the vehicle the same way that you would have took care of the vehicle? And so, high risk industries, again, you could be in a space where you got an 800. You could be in a space where, you know, you're netting $25,000 a month. There are some banks that will just still deny it. Credit repair, high risk. You got some banks that won't even open up a business bank account for credit repair companies, right? Why? Because they get a lot of chargebacks, you get a lot of refunds. You got a lot of people in that industry that may not be as ethical. And so, you know, that's something that you just want to keep in mind when you start talking about going out to get funding for certain businesses. Businesses that are low risk consulting companies, right? Businesses that are low risk software companies. Businesses that are low risk when you start talking about e-commerce and you've already shown that you've generated revenue, low risk. When you start talking about contracting, low risk. Clothing can be high risk because, you know, clothing is based on velocity. It's based on popularity. It's based on publicity, right? Do you have a lot of people coming and constantly buying your sweatshirts, your sweat shoes, sweat shorts, t-shirts, hats, you know, sweatpants, jeans? I mean, you got some people that have an insatiable hunger, you know, for designer, for clothing, right? But you have, you know, again, once it hits a wave, then it takes off. But how many people started clothing brands that just didn't go nowhere? Right. So that's one thing you want to keep in mind as far as that industry. That industry will either make you or break you. All right. Now, very last one we have here. All right, is one of my favorite. And I wrote it down. And this one is, I'll just write it again for you guys. It's your banking relationship. Your banking relationship can be the key factor in whether you get approved or denied. Now, not everybody will go in and just absolutely deny you because you don't have an account. But most banks want you to have a bank account with them. If you have a bank account with them, then you now are standing in favor with them because they now have access to all of your credentials. They have access to your savings. They have access to your checking. Banks, again, if it's not a credit union, they are in business to make money. So they're for-profit institutions. How do they profit? They profit off of issuing of credit cards, loans, lines of credit, mortgages, auto loans. But they also profit off of your money inside of those accounts because they're able to lend that money out, right? And so once you come and you actually invest in that particular bank, man, you now created a portal of favor. Because they have your quote unquote $10,000, $15,000. They have your $70,000 sitting in that bank. This is why oftentimes it's easier to get approved for funding when you have money inside of a bank. Because they can see that you're not really in dire need. They can see that you have capital with them. Man, the systems understand it. AI understand it. AI was trained to understand that for the banks. And so that's something that I want you guys to keep in mind. Prior to going in and applying, are you in a situation right now where you actually have an account with that bank? Now, again, not all banks require it, but I would venture to say about 60 to 75% of banks would want you to have a bank account with them. So that right there is super key. For people that are going out and applying and you don't have a bank account with somebody, I would caution you to at least open up one. It makes no sense to go out and get a hard inquiry, get your credit ran and all that good stuff just for you to be in position where you get to a space where, man, you technically can't even move forward in getting approved for funding simply because you did not have a business bank account. And one of the other things that I would highly recommend for you guys, man, is tapping in and ensuring that you have some sort of investment account for your business, whether it's a high yield savings account, money market account, whatever. But putting money there, you put money there, the whole name of the game is to not work harder, but to work smarter. You want that compounded interest working for you along the way. So, man, with that being said, man, that concludes the live for today. Man, happy blessed Tuesday on purpose. Again, my name is Jerron Tyler, founder of Posterity.ai, business credit software designed to help you maximize and expand your business credit by all means necessary. If you guys are watching and you need any type of personal assistance, I also founded our consulting company, Tyler Coaching and Consulting. You guys want to jump on a call? We offer free 15-minute discovery calls, and then thereafter, depending on which direction you go in, there is a fee associated. But if you want cutting edge expertise from an expert team, reach out. I have the Calendly. I have my calendar. My calendar will be in the description. It'll also be up in my links here on YouTube. So if you guys want to tap in, I look forward to connecting with y'all. Let's go! Man, y'all have a blessed one on purpose. And don't let nobody take your joy, baby. You're beautiful. You're amazing. You outstanding, dynamic, and man, you are beautiful in the sight of the Lord. Man, y'all have a blessed one on purpose. I love y'all.